Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info at yourmoneyontap.com. My name's Seth Krussman, and I am joined here once again by Dan McGlunn and Ben Brayshaw. How are you guys doing today?
Doing really good.
I'm doing good too, Seth.
All right, and we're going to be talking to you folks today about no pension, no problem. This, believe it or not, is one of the major problems that I think Americans and retirees are really truly facing. And so why do we say no problem? Because guess what? We are three-dimensional advisors. That's what we do, three-dimensional investing. We take a look at the landscape of retirement planning and what's your situation? How are you currently investing and what are your goals? And building strategies around, income. Not running out of money would be one of those things that we talk about in this idea. But anyways, we say no problem because why? Why when we solve problems all day long, we got nothing to worry about here, right?
Well, Seth, that's something we'd love to say that no one worries about, but truth is that's probably the biggest worry everyone has today in the retirement world is running out of money. How do I stop that fear from happening? And with the idea of potential lower rates of return in the future, which a lot of people are projecting to be the case, the fact that we have a low, interest rate environment even as we speak, and they're talking about raising interest rates, it's still one of the lowest we've ever seen in our economy. There's a lot of fears about running out of money and how to sustain an income in retirement through all those problems. And I think this is an important series that we're really running through to get our listeners, our clients, some answers.
Yeah, I think the most important thing about the issue is, or the easiest, quickest way to put your mind at ease about it is to get with a professional. Whether it's us here at Brayshaw Financial or any advisor you've been working with in the past. Like anything else, the challenge will seem less daunting when you have professional advice and you sit down and you really take the time to truly consider it the way that we do, as opposed to, that fictional chase of a number we always talk about in the commercials, right? That's not it. That's not how you solve this problem. But it is getting together with people like us who understand how to navigate through those times, and just a couple hours spent doing that, I think will put your mind at ease in a large way.
I mean, this pitch or no pitch, right? I mean, I think most everybody that comes through our door is working with somebody on some level, whether it's a big name brand, no advisor specific, or if they actually have an advisor. But if you're fearing the conversation that we're talking about now and you're thinking, man, I really don't want to listen to this right now because I don't want to address it, understand that everyone goes through a transition to find the solutions to put their mind and their heart at ease on the concerns that they're dealing with. And I think that's, if this is something that you're working with somebody and you're not feeling like those answers are done, I would go to them, talk to them about those issues, those concerns. But if that still doesn't bring resolution, or you feel like you haven't had the resolution, you can give us a call. I mean, we're happy to give you, and we talked about on our last show, a free analysis on your portfolio, your situation, to really review that and try to see if we can help you and see if, hey, listen, you're all set, your fears are unwarranted, or, hey, listen, you really do have an issue based on what your concerns are. And I would encourage all of our listeners to try to give us a buzz, and we'll get you in touch with one of our advisors, or if not, just us specifically.
So that's going to get us headed into our next segment, which is Money in the News. Daniel Wallace, I want to thank you for bringing to our attention that an Arizona CEO is has an answer to the Great Resignation. And what Chris Ronzio, CEO, is doing is offering a $5,000 bonus for new hires to quit. And if you're unfamiliar with the landscape out there for employers, it's a real challenge right now to really get the kind of talent on board and to stay on board. And it's a huge cost to develop talent and your workforce. And so this solution, I think, is brilliant, where 2 weeks in, Chris Ronzio's company is saying, hey, look, we're going to offer you $5,000 right now just if this is not the right thing for you. If you already know and you're just going to try to stick around to see whatever comes up next, let's just call it good. And we're not going to continue to invest in the training and the rest of the costs that go alongside here. We're just going to go ahead and say, hey, $5,000 for you to go ahead and figure out what your next step is, and everybody's good.
Yeah, this is really interesting. I mean, from the idea of, looking at the unemployment data constantly of what's going on, and the unemployment numbers, if people aren't following it, are just not where everyone's hoping they're going to be. And yet it's super hard to find someone to actually take a job.
Quick moment for another plug. Still hiring here. So if you're looking, give us a call, please.
I mean, it's amazing how many people that we can honestly say that we've invited to interview and just don't show. Yeah, if I wasn't going through this process, I would probably say, oh, that's ridiculous. But it's really crazy out there. And I think this is really interesting because I think there is so much time and effort, and we spend a lot of time in really interviewing people and trying to find a really good fit, because there's a huge cost in bringing someone on board and training and, just the overall dynamic of that process is big. And the cost is substantial. And so $5,000 sounds like a lot of money, and it is. But that cost over 6, 9, 12 months, and the person working there maybe not fitting in and so forth, all that money, if the person's not happy and they want to go, it's probably a good idea.
No, when I first read the article, or the headline anyway, I was like, oh, this is some other crackpot CEO idea that's sure to get this guy fired or bankrupt that company. But, the more I read it and just understanding that ongoing cost he was speaking to, especially to keep someone who's got no intention of staying, who's already not happy, you're just really wasting time and effort and money for everybody around them. It's not just the individual, it's not just their salary, but all the attention that trainers need to give them, and it just can be a drain on the company. And the more I read, the more it made sense to say, hey, listen, we all make mistakes in the hiring process, both from employers and employees, right? We've all either found ourselves in a job or made a hire that you knew pretty quickly on that just wasn't really the best fit. So kind of thinking back to those moments and those situations, $5,000 is not that expensive a way to get out.
Are you eligible for rehire would be my question. You take the $5,000.
Well, somebody's working on that.
Oh,
right?
yeah.
People are lining up at the door.
I thought another thing that was really interesting here is that Chris's company is Trainual, that helps small businesses onboard and train and scale teams. And that truly is an insider to the situation, and thinking outside the box here. And that's one of the things I really admire about tech, how there's just so much innovation that happens, and it's a space that really promotes and allows things like this to be, an experimental bed of solutions. And hey, good job.
This is a Bloomberg article from Ashley Vance titled, "Ready to eat some lab-grown meat? The FDA will soon decide." I mean, if just reading this article makes my stomach cringe. But this is a very, very scary scenario in my mind. This is called Upside Foods, Inc. They opened up a meat processing plant. It's a $50 million facility just outside Berkeley, California, and they're literally growing meat cells for packaging and processing. To basically sell to the entire world.
Yeah, I know. I'd seen something on this, and I'm just not recalling specifically where it was, but they actually, this was visual. This wasn't just something you read, but they had, you could see these steaks that they were producing. And
which were bleeding.
They were bleeding, and they had, fat and tissue in there. And it truly looked like a steak, So it's still a difficult concept to kind of get your mind around. And I certainly hope I've never eaten one or just not aware of it yet. But the reality is, in reading the article, that this is coming, because what I found interesting is that really the only pushback they're getting is from the lobbyists who work for the actual cattle companies and the chicken farms. But the the in-between, the meat distributors, the people who supply our restaurants, are not arguing this. The USDA, in fact, just put out some $10 million committee to kind of review this and test it and begin to get their arms around it, which just tells me, this is coming.
Yeah, this is getting embraced, which is really scary. This is the largest ever dedicated facility to cultivated meat, which is what it's called. So if you hear that tag, this brings us to a whole other conversation of like Beyond Meat, right? So this Upside, it's Upside Foods Inc. is not publicly traded from what I can tell. I did look it up briefly, but Beyond Meat is in the middle of trying to really replicate chicken. That's the whole thing about this, is trying to create as much likeness to real meat across the board. And I don't even know if these cultivated cells are really considered meat. Is it cloning? What's going on here? I don't even understand what they're doing. But the idea that this space has a lot of attraction now. Beyond Meat is down 50 some odd % in the last year. It's taken a huge bath. And there's a lot of analysts that are skeptical on its long-term viability financially of what it's currently priced. So I'm not sure that it's a buy or anything like that. But I do find that this entire industry is growing rapidly. And so therefore the demand must be there. I don't know if this has to do with, the cows and, methane gas. I don't know if, this is what's driving this whole thing. But there's clearly interest.
There's a difference, though, between as I'm just kind of processing it, too, is there's the plant-based alternative,
right,
which is one thing, right, versus it's meat, but it's meat grown in a laboratory someplace. It's different.
Yeah.
That's what I'm saying, right, Seth? Is it meat or is it not a plant?
No, it's meat cells, animal cells.
It's definitely meat. Yeah, I would say I would go that direction and say, yeah, it's 100% absolutely meat. And I think one of the things that they're eventually going to figure out here is how to get all of the things that you look for in, meat over the counter or your butcher or whatever incorporated here. Is it grass-fed, grain-finished, all those other things that they can possibly pull the levers on in the background. But, yeah, it's interesting to see what are the options coming down the pipe here. And if you've ever I'll speak for myself. I think I was vegan for a week after watching a Netflix documentary or something like that. I was like, oh my gosh. And then I started raising my own chickens, and I went all in. But I did start paying a lot closer attention because there's the biosustainability. Some of these, I think that's the right word.
For our listeners who don't know, Seth can raise chickens, and he also you still have the bees? Seth does bees too.
I do. Yeah, I still have bees. Yeah. They're fun.
Very interesting
Believe
guy.
it or not. These are my little side projects that keep me okay on the side, right? That's my therapy. As I go to chickens and bees on occasion.
I get stung every single year. I hate bees. I want nothing to do with that.
There's a consumer base out there that has switched over into much more of like a pescatarian or vegetarian type of diet, purely because of they really feel that this is an industry that is damaging the environment. So
I think the other side of this that's interesting to me is that you don't know what you're eating at McDonald's to begin with, right? Like if you go to McDonald's or you go to Wendy's or whatever, it's like So at the end of the day, what they're actually doing in this facility could actually be healthier than whatever you're eating at that place. But that being said, I think if you're really concerned about this, and I really do. I mean, my wife, studies nutrition. She's a certified health coach. Like this is I'm scared to mention this to her. So, but the thing about that is like when you go to the restaurant, how do you know what you really are eating? I think that's really the fear, and it could be at even high end restaurants. I think your point, Dan, is really well made. I mean, there's definitely an investment scenario here for whenever this company goes public, and this is not going to be the first time.
Oh, and they're not the only ones by far.
No, they just happen to be the largest one. And I think this is something out of Star Trek. It's like, the food pops up in a thing and you pull it out. It like never existed before. I mean, this is all that stuff. And I think you're going to be going to the butcher and you'll be like, I want the chicken that's, cell cultured by XYZ company, which has, because they're going to be you think about it, there's probably not the level of potential iron or nutrients that normally exists in animals that we utilize in our bodies. So they're going to, You're going to be adding, it's like going to a shake shop. Can you add the protein and you can add this powder and that powder?
Well, I was going to say, or it could be greater because, the food that they're getting out of wherever they're getting it. I mean, actually, some of our clients are ranchers, and that's one of the things they really pay attention to is their fields and the bioavailability of what's coming out of that field enhances the what's going on in the final product, and you just get a superior beef.
Next up here we have a market from CNN Business. Here we have by Paul LaMonica. Farewell Fangs, big tech stocks sink and Dow falls 350 points. This article is from Monday, January 10th. You're talking about simply the fact that, is this the shift to value stocks? And I think, they've been talking about this for years. They've been talking about the movement for that. I mean, it's been interesting watching, some of the energy sector I kind of think is the normal play, right? We just see that battle against energy. We've talked about energy rising. But I was watching Chevron the other day, and the stock just like, boom, banged right up. I mean, somebody's going in hard on a lot of these high-value stocks. I don't know where energy caps out. I'm getting a little nervous at how high energy is. I do think there's some room to run, but I'm not sure how aggressive energy is going to become in this space. But it's interesting watching the entire value sector start to move forward. I think that's interesting, especially because, we're looking at yields rise, but the value sector is still pushing, which means the yields are not anywhere near, in my opinion, enough for people to be really attracted to that investment space just yet. Because it's not I think the bond space is just a fear target, right? Like when you're all out, like the market's going to tank, boom, I'm going to bonds. But other than that, if you're kind of like, hey, listen, I just need a good yield, good, strong company, you're going to those blue chip value stocks. And I think that's kind of what they're talking about in this article.
Yeah, I mean, that trend, or the threat of the trend, right, the big move to value has been something we've been hearing, spoken of, and there's been some temporary shifts that way over the last 18 months or so. Really, as everyone's been mindful of the 10-year Treasury rate, right, that's kind of a key peg that everyone looks to see what direction interest rates are moving in the future. And as interest rates rise, these tech companies that don't have present earnings on their balance sheet, become devalued. And that's kind of the thing here is this move really going to become entrenched and lead to a long-term trend, or is this just another one of those kind of temporary shaking of the foundation of that whole growth world, tech world? And it's really hard to predict that, but there certainly are indicators that we look to that kind of give you the best guess you have looking forward to see what those kind of short, near, and long-term returns are going to look like.
Yeah, NASDAQ falling to 9% below its recent all-time high, putting it into potentially a correction zone of 10% lower than the recent peak. It's not necessarily all just the FANG stocks, right? There's more out there that it's kind of bringing up to the question of what's going to happen here. And really the Fed raising rates, I think, is behind a lot of what we're seeing in this the sector as a whole, just starting to pull back.
Well, I think that does it for us and Money in the News.
So, hey, today, guys, we are going to be talking about No Pension, No Problem. If you caught us last week, it was a really good show, kind of an introduction to a few of the series that we're going to be talking about. And what is the context here is you entering retirement, have done all this work to gather these assets. Now it's all about income. How do you create? How do you sustain? How do you do this piece in retirement? That is ultimately it is the problem, and it is the answer as well. So we're going to have some fun today talking about this with you. We're going to take a quick break, and we'll be right back. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Do you have an annuity? Do you understand exactly how it works and when to use it? The likelihood is that you don't, or maybe you bought it a while ago because at the time it sounded like a good idea. But will it accomplish your goals? We are here to help you. Contact us about a free annuity review and learn what your annuity does and how it can best help you in your retirement goals. It's absolutely free to you, and if there's a better way for you to accomplish your goals,
this is a great way for you to learn about those opportunities too. Take the time to get educated, get empowered, make your retirement a success. Call us at 855-226-8551 or info@yourmoneyontap.com.
Now back to Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And today, folks, we're talking about no pension, no problem. So if you're unfamiliar with Money on Tap, who we are, what we do, we want to welcome you and thank you, first of all, for spending the time here with us today. All three of us, Dan, Ben, and myself, are retirement planners with Brayshaw Financial Group. That's our company, and Money on Tap is our podcast. And this is an opportunity for us to dive into one of the most significant pieces of retirement, and that is that income piece. The traditional piece out there has been that pension, the Social Security, and other assets alongside of that people have used. But pensions, are they still here? They're kind of a going away situation for us. And so we want to make sure that we're addressing this.
We've chatted about annuities in the first show, and this is a little bit of continuation / transition to the next step. But what we have seen in the pension world, which is really interesting, is in 2014 to 2019, over a 5-year span, we've seen a decline of anywhere from 50 to 80% in the pension arena, in the distributions that are actually going out. For instance, in 2014, Social Security was about, on average, only $15,871 on average per person. But, yet, as we move forward, you're looking at them dropping to an average of around 10,000 in spendable assets. So there's a pretty significant, decrease in value, and that has to do with inflation, that has to do with all different pieces, right? And then as you start looking at the overall pension space, the actual amount of pension distributions are declining as well over that 5-year period. All this stuff, this information you can gather from the Pension Rights Center and what's kind of going on in that space. And there's a lot of material here to kind of break down into understanding it. But what we are seeing is that the percentage of a person's retirement assets between Social Security and pensions are quickly and very rapidly declining as a smaller and smaller and smaller income percentage of someone's retirement. So if you think of like the pension being, 40, 50% between Social Security and your pension plan, 5 or 10 years ago, now it's like 20% of the overall asset space, which is in the same capacity. The conversation around annuities and the pension-like nature of annuities has been increasing on almost every domain. Like every one of our listeners has a friend, a brother, a sister, a family member, a neighbor who said, "Yeah, I got an annuity and took care of my income problem." There's a listener out there that has heard that across the board, and it's becoming much more commonplace conversation because the provision of the pension and the dependency of the Social Security has become a concern. The pension is either non-existent or has declined or been shut off and capped, so you're now, your pension numbers are not getting larger any longer. And so that has increased the conversation around how do I get that security around income. That conversation, social media, Googling, all those factors across the board have increased. The demand for that information has increased.
Ben, I want to just jump in here. Just a quick list here of the conversations, who's having these conversations out there. It's J.P. Morgan, it's Wall Street Journal, it's Barron's, CNBC, U.S. News, Forbes, American College of Financial Services, you name it. You can find something out there addressing this situation and bringing in annuities as one of the solutions, but the primary solution is what I would say as well.
Yeah, no, I would agree. I think that's a great point too, Seth, because it's people actually seeking out the information has grown at a scale of I don't even know what the numbers are, but the amount of interest in it and the reports we get is just like everyone wants to know about annuities. Everyone wants to know how it could solve their problem and their pension issues. People are looking for solutions around retirement. They're seeing the stock market at all-time highs. They're fearful it's going to either not grow well or not grow like it did, or it's going to have a huge crash. Like those conversations are very, very serious and large concerns. And they should be large concerns, especially for someone who's entering retirement looking to mitigate their income needs. But the fact that you have major publications having, spun 360, gone from, hey, this is your, like, think about it. When you go to Barron's, you're looking for stocks and bond information. But Barron's is reporting about annuities and how it's an alternative to bonds. There's all these different pieces out there that these publications are driving hard.
Yeah, I mean, I was just looking at a study, and there's an article that I found and kind of supporting all that. And this is a little, less numerically measured, more of kind of the psychological effect of these things. And what the article was pointing to in the study that they'd done, very strongly suggests that people that have annuities as part of their retirement picture overall, have better retirements, and they're much more likely to enjoy their time. And what it comes down to is the simple fact that when people are planning their retirement and they're taking a look at large expenditures or trips or things that they want to do, the presence of that other predictable paycheck is really what gives them the peace of mind to go ahead and do it. Because they were contrasting people with even kind of a lesser total asset pool was against people who are able to make those decisions easier and enjoy retirement, is that people who even have vast sums in their 401ks or other type of asset accounts, even if they don't have any heirs in mind to leave the money behind, they really just have an issue and a strong negative reaction to spending that balance down. Something about the simple effect of seeing the statement when that $10,000 trip comes off the top. So that negative value, or that decrease in the values that they've become so entrenched and trusting in making sure that they stay around to ensure that their retirement does last, it has such a negative effect versus the people who simply know they have that predictable paycheck coming. So they're much more willing to take that expenditure on. They're much more willing to go for that trip because they don't necessarily see that negative result in the bank account because they know that next check is coming to replace it.
Yeah, and I think that's the piece that, everyone was used to or didn't feel like, the annuity was part of the conversation in the past, was because the pension and Social Security, already met that fear. It already took away that concern. Yet this whole new generation, this whole second half of the baby boomers coming through, this 80 million Americans, which is why the annuity space is just, growing leaps and bounds, and the demand for all of the security that people are looking for is just being driven left and right. So insurance companies are responding to this, and they're dealing with the fact that, market trends and the stock market going up and down constantly just drives real fear. And, for years and years, people, they're making 8%, 10% in the market, whatever their historical average is. But we have talked about this over and over and over again. It's not about those returns, because you can't take out 8 or 10% because you average that. If you did, you'd run out of money in, literally 8 or 10 years. I mean, it's that fast, because one negative year on top of your withdrawals just absolutely crushes your portfolio. It literally decimates it. And people don't understand how to mitigate it, but that's why we have all these things called, simulation programs, which Monte Carlo is the most common one, where you figure out how much you can take out and mitigate those ups and downs in the market so you're not eating into your principal. And I said this on the last show, and we've all repeated it. And if you haven't watched the sequence of returns video on our website at BrayshawFinancial.com, you need to go there and watch this, okay? Because you just won't believe it. But brother and sister both have the same money, retire 3 years apart. The sister retires 3 years after the brother. Her first year is positive. The brother's first 3 years are positive. They take out exactly the same money. He becomes super wealthy. She runs out of money. They're nothing different. Same investments, same strategy. All that stuff is literally, and it puts a lot of fear inside people, because everyone intrinsically knows that's a problem. And that's why they know they can't take out 8 or 10%. They know it's a problem. The biggest problem that really happens, though, is even though the averages and what the market's done over the last 10 years is fantastic, the volatility of the market creates a lesser distribution rate at a successful amount. Now, even in the past, when the market did good and did well, didn't return as well as the last 5-10 years, you could actually take out a higher percentage because the volatility was lower. So it's really interesting how volatility plays a huge role in that, and and how insurance companies have brought that to brought solutions to the table. And Dan, you were going to talk about how that works.
Yeah. So the insurance companies are able to do the same thing that pension programs do, right? So there's the insurance company and the pension versus the individual investor, and what happens there is that insurance companies know, and just as a pension would, when they're dealing with large pools of people, so many, many lives under their control, or not their control, but many lives they need to account for.
Sorry.
That person lives, that person dies.
Yes, they don't exactly pick and choose that, but there's
Which
probably
matrix are we living in?
some underwriters you don't want to ever meet, probably. But so the insurance companies and the pension programs know that when they're dealing with many thousands of individuals, they know what their life expectancy is going to look like on average for the entire group, right? So that's an easily predictable number for them. So if you're 65 years old today, either one of those opportunities, whether it's an annuity company or pension program, knows they have to plan on providing income for about 21 years for the entire pool of people on average, right? So they were able to lock down that number and take a look at the total pool of assets they're dealing with and figure out what a reasonable distribution rate is off of that number. Whereas if you're an individual investor trying to do this on your own and you don't have a guaranteed income tool in your portfolio, you can't plan on 21 years. You don't know for sure that that's going to be long enough. You have to plan more realistically for something like a 33-year life expectancy. So if you just think about the difference between a 21-year retirement and planning for a 33-year retirement, you can see simply that you'll be able to withdraw less to make sure that you have the same probability of success being defined as not running out of money before you die.
Well, I think, Dan, when you talk about 33 years, an average 60, that's 98 years old, right? that is the vast majority. That's 95% of the population, will live within that time period. So you still have a 5% disparity. And I think the thing is that we look at all these charts and, okay, so you're over 65 and you're married and you or your wife are both over 65. There's a 25% chance one of you is going to live to 100. And as as medicine and advances occur, right, I can only foreshadow that life expectancy will continue to grow. And we won't know what that life expectancy is for a real 65-year-old until we're 33 years on, right? At 33 years on, this is just the current historical data, right? So that's why the insurance company actually bears that huge burden. It could be that when you're both married over 65, there's a 50% chance you could live over 100, but we won't know that until 35 years from now.
Right.
The real numbers, right? We're just taking the statistics based on the growth and everything else. But we might be able to solve a lot of medical problems over the next 35 years. I think about the advancements we've had.
Just talking about growing meat, we might be harvesting organs, and who knows?
Yeah, no, all of that stuff is, if you're growing meat, you can grow an organ, I guess, right? So, there's real likelihood that this over, living past 33 years, you could be buying. This is the thing I think about annuities, right? In this mentality and thinking about the expansion of how far things could go and how long people really could live, that we won't know the truth till 35 years from now. And let's say that, if 20% of those people die from cancer and we find out the perfect cure for the most common cancer and we can just completely eradicate it, all those people now are outside the cancer death pool and they're in the heart attack death pool. But let's say we solve and we come up with a new heart, right? That's a 18-year-old version of a heart. And you stick that in somebody, right? And now all of a sudden the heart issue's gone. Now everyone's living to 105 or 110. The average person dies at 95. You bought an annuity today that has a life expectancy payout on 21 years, but let's say the new average goes to 35 years. They can't offer that same payout, but you own an insurance product that has a guarantee based on a certain payout that they have to pay, that's insured. So you think about that, the actual likelihood of actually outliving the insurance is only in your favor, in my opinion. As
We talk about that whole concept, and it's not necessarily to that exact point. But when I'm explaining an annuity to a client or someone I'm sitting down with, I often talk about the transference of risk. Right? If you're an individual and you own a pool of money, and you need to make it last for your lifetime, so that you don't end up destitute on your deathbed, you're going to own the risk of managing those distributions. Right? It could be successful, could not, but either way, you bear the risk in determining how much to spend and how frequently to spend it against whatever you're able to return. But when you put some of that money into an annuity, you've transferred the risk to the insurance company, because they are already committed to, the day you sign the contract, a lifetime income stream for you at a variable rate, fixed rate. There's lots of different flavors of that. But the bottom line is this, is that they have committed to provide you an income for life. And their obligation is rock solid, and they're 100% tied to that.
I would even double down on that transference of risk to say, let's say you're the husband managing the money, and you statistically aren't going to live as long as your wife, and now you're going to hand over that risk to your wife to now make sure, at probably a time when she's the most vulnerable in the management of assets, right, to make sure she's cared for. And the truth is when you transfer the risk, you can transfer it and have a joint income for husband and wife, right? And then all of a sudden you're transferring the risk of your wife not being able to deal or manage with those assets at that time as well. So, I mean, the thing is that how much risk you want to transfer is totally there. And I think, and there usually is, I mean, you guys see this all the time, right, Seth? I mean, we've got one person in the family, Dan, right, that only manages the money, and the other person's kind of taking care of other responsibilities. And it's just the separation of duties that kind of happen in a natural household. And if the person who handles the finances goes first, the person who gets the finances now that has to handle them, right? They're the person that's never been doing it, has to figure it all out, and now they have to go get their PhD instantly.
That's a very difficult transition there. I mean, you find people, sometimes they're relatively in tune and aware, but there are definitely circumstances where the survivor hasn't got a clue as to what's been going on or what will go on, and they come to you with, after the grief is settled and all the, the hardship that goes with that, just a pure state of panic about, do I have enough to keep on going?
Folks, you're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about no pension, no problem. And when we come back, we're going to get into some real-life numbers and understand a little bit about, what we call dollar cost ravaging in a real scenario here, and what that negative sequence of returns looks like. We're also going to get into some more solutions here for you around creating your own personal pension or synthetic pension. I like that one a lot too, Ben. Thanks for highlighting that name. I'll use that regularly as well. So you're listening to Money on Tap. We'll be right back.
Call us today at 855-226-8551 and get your free consultation with Ben Brayshaw or Seth Krussman or any one of our partners, and find out what's going on in your plan, your estate plan, your financial plan, or what you're planning at all, if nothing. Get it fixed, get it right, get it done today. Give us a call at 855-226-8551.
Now back to Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Today we are talking about no pension, no problem. And what does that even mean? We're talking about a pension that is now paying 50% of what it used to in the past 5 years. That's the numbers that we've seen declining and what those pension payouts look like. We're also talking about building synthetic pensions or creating your own pension because, this pension going away, retirement landscape changing, what used to be used for the retirement income platform or landscape just isn't the same. It's not. And so we're talking about some other options here. Then why would you want to consider this? And one of the things that I wanted to talk about was, that negative sequence of returns. First of all, I am not going to do nearly as good a job describing what these numbers look like as if you went to Brayshaw Financial Group website and looked up in the resources there, the sequence of returns. It's negative sequence returns. It's a video that does a far greater job of helping you to understand what it is that I'm about to describe. But with that, I'll do my best, and we'll see how well this gets articulated in your mind as I'm giving you some of these pictures that I'm looking at and talking about. What we're talking about with negative sequences of returns, or a ravaging of a portfolio, is this. Let's say you have set dollar amount. Remember that ING commercial? What's your dollar? What's your number? Well, you get your number, right? And then based off of that number, you're going to use some other averages over here of what the market has done. Well, if we were to articulate this 60-40 portfolio, which is everybody's go-to for retirees to manage that portfolio in retirement. We're going to minimize some of the risk and the volatility, and we're going to take some income off of that dollar amount that we've saved to. And if we were to take an average return of 9.1%, which is the chart I'm looking at here from JP Morgan, and use that number, okay, but we were only going to assume, okay, that we're taking a 5.2% withdrawal rate because 9.1% return over time, and we take 5.2% withdrawal rate. That should give us a safe margin of error of withdrawing those assets. And if we were to back this sequence up into, let's say, 1966 to 1995, what was going on during that time? Well, you had some pretty decent bond returns throughout this period of time, which bonds were kind of the asset that everybody relied on, right, to create this income for themselves. But you also had some really challenging times for the first 10 years of that retirement. And those are the critical years for most everybody to understand. And nobody has the ability to say what's going to happen during those market timing. But people retired during that time. They had adequate amount of assets to live through, and they were doing a pretty responsible job of only taking 5.2% out of that portfolio. All right. So what happens is this portfolio actually winds up spending down over time. Okay, and it runs out of money by age 89. Okay, so if you don't want that to happen, and if you don't want that risk, and you're not wanting to take on that risk yourself, what are the options? Okay, so what we can take a look at here in this chart as well is if we were to assume an 8% return, okay, and we were to use basically a different structure around a spend down strategy or a consistent kind of an annuity payout of some of these assets, then you could experience a very, very different life cycle of your assets that way, ultimately giving you durability in that portfolio because you have that consistent payout. You're not having to deal with the fluctuation of the market. And this is through a process that we call, building a synthetic pension, or building your own pension. And that's why I always say no problem, because we've got tools out here to help to mitigate some of this risk that you're looking at in this corridor of retirement for yourself.
Seth, when we were talking about in a previous show that we did, the 7 potential pension solutions, we talked about a lot of different things that people utilize to create income, right? And that's across the board. And so, as we talk about, the pie of retirement, the slice of that pie, there's clearly a slice of that pie that flies into the annuity space that we're talking about today. And we're going to talk about fixed income, and we're going to talk about equities. We did talk about those previously in different segments of the various, income programs that you can build in retirement. And I think the thing is that, and if anyone listening today or any version of the recording of this, in our podcast system, if you're listening today and understand that, an annuity, a pension, any of those things, anything providing you a guaranteed income that you don't have a general physical full access to, because you are going to give up some, control over that, allocation. Pensions, you've got zero control, right? You've got zero access. You just get the income. With an annuity, you get a little bit more access than that, but you give up some control for those guarantees. But, it's not for all your money. This might be a third, or, depending on your demand and need of security and stuff, that, that third of the asset might go up to a half. Or if you really don't need that much income and you've got a lot of extra assets, well, now maybe that's down at 15 or 20% of your assets, right? So the variable of how much you might put into something and create a pension-like scenario, you're going to add up your Social Security. You're going to add up your current pension if you have one. You're going to say, well, I really want this much security, and then you're going to provide that income number you want and work backwards into the annuity potentially that fits that need. The other income, the fixed income, the equity space, you're going to figure out how you drive income from that. And I think, Dan, when you were talking earlier about, feeling guilty about taking money out of your portfolio because you went on a trip, boy, that is so true. How many people actually just try to live off of their returns, and then like the market's going down, down, down right now. We've chatted about pullbacks. We've talked about how, as rates go up, we've talked about how, technology is going to drop, that kind of space. And right now people are saying, hey, the world's opening back up again. And, Omicron and this, that, and the other thing. I mean, I've seen 5 articles about how that's basically the end of coronavirus as we know it. And I don't know if you saw that article the other day. But, if that's true and that's really the outcome, then the trip's right around the corner, and yet your market portfolio is going down. Do you want to not take out money from your portfolio today to go on the trip that you've been waiting for 2 years? And I think, knowing that you can just figure out how to take out for specific scenarios, and that your core expenses are taken care of by your pension, by your Social Security, maybe your annuity, maybe your yield off your dividends. Like you're not actually selling stock, selling items. Like when that stuff is cured and you can just live your life, you can just enjoy it. And that's, that might sound altruistic, or, maybe people feel like that's just too good to be true. But the truth is that you can set up a portfolio that's well balanced, that meets all of those things and provides the income for you. And I think you take a lot of that mitigation of the market out.
Yeah, I think that's the peace of mind we keep referencing, and the net effect of working with professionals and folks like us. And we certainly welcome you to come in and specifically use us. We hope you do. But what we're able to do is have someone go through a simple process of laying out what their expected expenses are, right? Their core expenses. You've talked about this before. What's the rent? What's the mortgage? What's the food cost? Your cell phone bills? Just the things that you truly can't live without. We were able to break that down into a monthly cost. Then we take a look at what your expected Social Security income is, what your expected pension income is if you have one, and we take a look at those two numbers, right? So we have core expenses and we have core income. And generally speaking, there's a little gap in there, right? But then we have that other investment pool to work with. We have your 401k. We have the non-qualified investment accounts. So what we're able to do is take a portion of those things, put them into a guaranteed income tool like an annuity, not necessarily in every instance is it an annuity, but something along those lines, so that you can walk out of that meeting feeling pretty thoroughly convinced that your core expenses will be met, and they will be met for the rest of your life, at least as far as we know them. And now whatever's left there, that excess balance that we use in other kind of more market-based, equity-based investment tools, that's what you live out of, right?
Yeah.
If we have a big month or a big quarter or a big year, take your trip. If the market conditions haven't gone the way you might like, well, maybe put it off to next year. But either way, whether the trip's this year or next, that your core expenses will be covered.
Well, when we talk about the retirement pie, and we talk about your pension, your annuities, your Social Security pieces of that pie, we talk about your fixed income, we talk about your equity strategy, we talk about all those different pieces because they're all part of the pie. Like you're not going to walk into this door and not have a conversation about each one of those pieces of the pie. I mean, that's just not the way we work. That's why we do 3-dimensional investing. That's why we do retirement planning with all the different cores. I mean, we're fiduciaries. This is all the pieces that we provide. I think the thing that's interesting is that we talked about, compounded loss and sequence of returns. When you're taking out a one-time distribution for a trip from your equity portfolio or your fixed income portfolio, right? It's a one-time additional distribution. The destruction of a portfolio from the sequence of returns is taking a distribution you have to take every year from that portfolio in those down years. If you take one distribution in one down year to do one trip, and you're not doing that year after year after year, you allow the portfolio to relax and to breathe and to recover, and you can recover those assets. But if you're constantly putting that downward pressure of distributions on that portfolio, that's where the crash and burn happens in a negative market scenario.
Yeah, you don't want to draw your core expenses out of that. That's not what you want to do.
And so when you create that foundational event that's solved, that's taken care of, then your one-time distribution to do a trip, it's a blip on the radar screen. It's not a catastrophic decision that you've done year after year after year. Because, Seth, when you were talking about the distribution model here, and I think you did a really good job pointing that out, you run out of money at age 89. The piece I probably cut you off on earlier was the fact that, the husband retires at 65. The wife is invariably 2 or 3 years behind, right? So he's run out of money at age 89, which is just a year or two past his life expectancy that he may live way past anyways, right? He runs out of money at a 9.1% average return. I mean, taking out just 5.2%. Now, Monte Carlo says we can take out like 3-something% now because of that volatility we talked about earlier. But what about the wife who's trailing behind 2 or 3 years longer, that she's literally living impoverished because you've run out of money and the stock market averaged you 9.1%? I mean, if that doesn't mean something to somebody listening today, that the insurance companies are able to hedge these investments. They're actually able to buy investment vehicles that you can't buy financially in a well-prudent scenario to offset losses. It's a way of mitigating all the issues and at a significantly higher income rate than any Monte Carlo statistic will bring. And the truth is that if the insurance companies are wrong on their numbers, they're insured to still pay you. And guess what? If they're wrong, that means you lived a really long time. And then our story is even more relevant today. I'm looking forward to talking about the equities and fixed income. I mean, that's what's coming up next. I mean, that's exciting. This is when we put smiles on people's faces when they say, hey, I can go on my trip every year. Oh, all my bills are paid for. Everything's taken care of. That's where, Social Security, pensions, and annuities kind of fit that void. And then we'll talk about how we can mitigate all the other expenses through the other pieces. And I'm excited about that part.
Yeah.
That's the fun stuff for us.
Most of the successful retirements we build, have these core elements built into it.
Yeah.
Yeah, what you're talking about there, we put it into so many different terminologies, and one of them is just the foundational elements. And there's no one size fits all, but it is super critical to have layers of protection and different pieces, building those foundations for you to be successful in retirement. And that's one of the things we're talking about here. And yeah, like you said, I cannot wait to get into some of the other ways that we create income in retirement, and this just being one of them.
You've been listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. You can also find us at Facebook. We're at /3D Investing. We're also on Twitter at BFG_LLC. And as always, you can also find us at yourmoneyontap.com.
Make it a great week.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551. All guarantees protections are subject to the claims paying ability of the issuing insurance company. Mutual funds and variable annuities are sold by prospectus. Please consider the investment objectives, risks, charges, and expenses carefully before investing. The prospectus, which contains this and other information about the mutual fund and the variable annuity contract and underlying funds, can be obtained from your financial professional. Be sure to read the prospectus carefully before deciding whether to invest. Fixed annuities are insurance products and are designed for long-term retirement income. Annuity guarantees are subject to the claims-paying ability of the insurance company. Surrender charges may apply if money is withdrawn before the end of the surrender period. All withdrawals of tax-deferred earnings are subject to current income tax, and if made prior to age 59 and a half, may also be subject to a 10% federal income tax penalty. Annuities generally contain fees and charges which include, but are not limited to, sales and surrender charges. Additionally, if purchased within a qualified plan, an annuity will provide no further tax deferral features. The contract, when redeemed, may be worth more or less than the amount used to purchase the annuity. Fixed annuities are contracts, and you should read and understand the contract before making a purchasing decision. All other benefits are available for an additional cost. It is important to weigh the costs against the benefits when adding such options to an annuity contract. An income rider or benefit, sometimes called Guaranteed Lifetime Withdrawal Benefits, or GLWB, is an additional feature available with some annuities and generally optional and comes with additional cost. Income benefits are designed to provide income options above and beyond the standard annuitization or free withdrawal features in annuities.
Well, bye.